Welcome to Introduction to Accounting, Preparing for User's Perspective. Deferred revenues. Cash is received before revenue is recognized. In the accrual accounting video, where I introduced the revenue recognition principle and the matching principle, I went through the following key points about when revenue should be recognized. Revenue should be recognized in the accounting period when they become realized or realizable and are earned. That means you have to deliver a good or service. You should receive cash or claims to cash, such as receivable, or assets that can be readily converted to cash, and you should substantially complete or deliver the promised goods or services. When these criteria are met, then you would recognize the revenue. Also in that video, I introduced the 3 common revenue recognition situations. In this video, we will talk about deferred revenue, when cash is received before the revenue is recognized. In this case, cash is received in the first year, but the revenue is having to be deferred until it's actually earned in the second year. The best way to learn how to deal with deferred revenue is to simply do an example. On November 1st, X1, Landlord Co. received $18,000 cash from Renter Co. to pay for the following 18-month rental period to end on April 30th, X3. Record all required entries and adjusting entries for 20X1 to 20X3 as per the revenue recognition principle. Per the revenue recognition principle, when should the rent revenue be recognized? I have found that in situations like this, the best thing to do is draw a diagram that helps me to visually see when this landlord is earning the revenue. I first start with the key dates. November 1st is when the landlord received an $18,000 payment that would cover a period extending to April 30th, X3, 18 months later. In this case, it's $18,000 paid for 18 months worth of rent. The monthly rental rate would then have to be $18,000 divided by 18 months, or $1,000 per month. If you think about the math then, the first 2 months would be $2,000 earned in X1. The next year has 12 months for $12,000, and 20X3 has 4 months for $4,000. That's what should make it into our books. So if we finished 20X1 income statement and it doesn't show $2,000 of rental income from this situation, we did something wrong. In X2, if it doesn't show $12,000 of rental income, we did something wrong. And in X3, if it doesn't show $4,000 of rental income, then we did something wrong. That's when it should be recognized, because that's when the landlord earned the revenue. Now that we have the vision of the revenue recognition in our mind, let's do the journal entries. On November 1st, cash is received. So this is a debit to cash, increasing the cash account. Now the question is, what should the credit be to balance out this debit to cash? If we earned all the rental revenue in X1, it would be a credit to rental revenue, but we didn't earn it yet, so we have to say we owe the tenant $18,000 worth of rental services. This is called unearned rent revenues, meaning we owe the tenant $18,000. Now, as time passes, this liability will decrease and the landlord's revenue will increase. Down below, I've shown the unearned rent revenue ledger account in T-account format. As we post journal entries to the ledger account, we will update the balance. I won't bother updating the cash and the revenues account, just the unearned rent revenue, so we can track what's happening in this given situation. By posting our credit to unearned rent revenues to the unearned rent revenue account, the unearned rent revenue account increased by $18,000. We then have to jump to the end of the year and say, okay, have we earned any of this unearned rent revenue? The answer is we have. We've earned 2 months worth. So we would have to reduce that liability by $2,000 and record rent revenue of $2,000. How much in rental services do we still owe the tenant? Let's post the debit to unearned rent revenues of $2,000, thus arriving at $16,000 of rental services that we still owe our tenant. Let's jump on to the next one. In 20X2, we didn't receive any more payments from the tenant, but we did earn another 12 months worth of rent. So let's record that. We have $12,000 of rent revenue that we've earned, but the tenant didn't pay us in this year, so we can't debit cash, but they did pay us in the past. So we will reduce our liability to them. We've now earned $12,000 of this $16,000 payment. We have now earned $12,000 more of this amount that we received payment for. If we post that to the ledger account by debiting unearned rent revenue $12,000, Our new balance amount owed to the tenant is $4,000. Jump to the next year. We have to record another adjusting entry to show that we've now earned $4,000 and thus reduce the remaining liability. Let's post that to the ledger account, and we show that at the end of this year, we owe nothing more to this tenant, and this deferred revenue has now been fully realized and recognized on the income statement. We showed that we were supposed to have $2,000 of rental revenue in 2000X1, and that's what got recorded. $12,000 in X2, and that's what got recorded. $4,000 in X3, and that's what got recorded. It appears that our journal entries properly updated the rent revenue account to show what we've actually recognized. Do our recognized revenues comply with the revenue recognition principle? Yes, they do. On December 14th, X1, Roofer Co. received $5,000 cash from House Co. to install a new roof in February X2 of the following year. On February 8th, X2, the roofer incurred $3,000 of cost to install the roof. Record all required entries and adjusting entries for 20X1 and 20X2 as per the revenue recognition principle. Per the revenue recognition principle, when should the roofer recognize the revenue? The answer is when those revenues are realized or realizable and he's earned it. Well, how does a roofer earn revenue? He puts on roofs. So 12/14, he received payment, cash was received, but no revenues are recognized because he hasn't done any work yet. Whereas on February 8th, he did the work, and that's when the $5,000 of revenues will be recognized. Let's do the journal entries. On December 14th, he received cash. What should the credit be? It can't be revenues because he hasn't earned it yet. In other words, he owes that service, and therefore it's an unearned revenue. Posting the unearned revenue to the unearned revenue account, that's a credit of $5,000. As of the end of X1, no adjustments are needed because he hasn't done any work to earn that revenue. So the ending balance is still $5,000. In the following year, when he actually does the work, he's going to recognize revenue of $5,000 and reduce this liability by debiting it. He also needs to recognize the related expense, which is $3,000. So he may have taken the asphalt shingles out of his inventory, credit that, and debit cost of goods sold $3,000. And we'll assume he did all the work himself, so we won't worry about the employee wages expense. By posting this debit to unearned revenues, we now can update the unearned revenue account to show that the balance is zero. To summarize what we just did, on 12/14, the roofer received payment, but we knew that no revenue should be recognized. Then on February 8th, he delivered the service, and we knew that $5,000 of revenues should be recognized. Is that what made it onto the income statement? Yes, we had $5,000 of sales revenue in X2, and we had no revenues in X1, and we've handled that properly. Revenue recognition key points. 1. Only recognize revenue in the accounting period in which it becomes realized or realizable and earned. 2. If you receive a prepayment, it really should be a liability until it becomes realized or realizable and earned. The name of that liability is often referred to as unearned revenue. 3. At year end, review all unearned revenue account balances, which will appear on the balance sheet, to determine if you have now earned some of them and adjust them accordingly. In other words, you just look at this as, hey, haven't we earned some of that? If so, reduce the liability and record the revenue on the income statement. 4. At year end, review your revenue account balances to ensure you really did earn all of them and adjust accordingly. In other words, look at these revenues, and if there's some revenues in there that you know you haven't earned yet, you might have to reverse them out by debiting revenues and setting them up as an unearned revenue. I hope this has helped you understand one of the accrual accounting issues with revenue recognition, which is called deferred revenues. Wish you all the best in the quiz. Aloha.